Webinar. Thank you for being patient for us to let you in there. And thanks to you all for joining nice and early. We'll get started in a moment or two. Just wait for all the late arrivals. If someone can pop in the chat, let us know we're coming through okay. Brilliant. Thank you, Dan. Thanks, Stuart. Welcome to those who are just arriving. Okay, going to make a start, Adam, if that's okay.
Sounds good.
Super. So I think most of you know me and Adam, or me or Adam. One of us, at least one of us by now. I'm Paul from MAP, and this is Adam from Pura Vida. And we're going to cut straight into it because, as I say, most of you know us. Most of you have read summaries from yesterday, listened to summaries, watched it live, unfortunately, or used AI to tell you what's going on. So we're going to try and make it as practical as possible, but it's more signposting to let you know that we're here to talk to you privately. Usually I've been encouraging lots of Q&A and lots of chat, but in a session like this, one, want to be careful that we're not getting political and complaining about all the stuff that come through yesterday. Secondly, we've only had a matter of hours to digest this information, and we want to be able to advise you properly. One, based on your unique circumstances, rather than what's happening from a macro perspective, and secondly, to do it privately as well with you. So I'm not saying don't ask questions. Feel free to ask questions, but don't think that this is the end of being able to speak to us about this stuff. We can speak afterwards. So without further ado, if it's okay with you, Adam, I'm going to jump straight in.
Sounds good.
So in no particular order, the tax and national insurance freezes, if you like, in terms of the personal allowance, which is often described as a fiscal drag. Do you want to talk us through? I like to compare the before and after, so that people know the perspective if they weren't sure what these thresholds were before. Do you want to just explain what's happening there in terms of the freezes on both income tax and national insurance for employees and employers?
Yeah, I think this is one of the big highlight things for the budget, actually, in terms of been a lot of talk, manifesto promises about not increasing tax on working people. So I'll get this out the way early without getting too political. It's nonsense. One of the biggest things that's happening in terms of tax increases this year is on people's earnings, whether that be from paid work or whether that's through also pension income as well. So what they're doing is they've extended freezing the tax thresholds until 2030 now.
Yeah,
So as a headline, that's creating an extra 8 billion of tax a year on people's earnings. So
yeah,
whilst there isn't a direct increase in income tax specifically, there
yeah.
is an increase in our tax overall that we'll pay.
Yeah, the effective rate of tax is how I would see it. Like the more transparent way of doing it would be to increase the income tax rate slightly. But by freezing the personal allowance, effectively, you are going to get taxed more. I calculated that if the personal allowance had risen by inflation, just like you would expect earnings to, so therefore fairness, the personal allowance would have been £4,900 higher by 2030 than the 12,570 that it's going to be. And the higher rate threshold would be a whopping £20,100 higher
Amazing.
than it is today if it had increased by inflation. So that's just gives a bit of context as to how much this is hitting people.
Yeah, I think that's a really interesting thing in terms of the budget is historically the percentage of tax against GDP is the highest it's ever been. So people are feeling the pain at the moment because of inflation, but also because of the tax. So I say if there's anything to feel negative about the budget, this is one of the big things I think for sure is there's a lot of talk about helping people, but the reality is it's getting more expensive as well. So we've got high inflation that's driving up the cost of everything, but also the tax take is increasing as well. That is impacting. uh, quality of life and living. So one of the stats we have on this is by 2029, 2030 tax year, it's going to be an extra 900,000 people paying higher rate tax. So that's the kind of, that is working age people in terms
Yeah,
of the so-called middle class. It's not what they're talking about in the budget as a headline of taxing the rich. And I
yeah,
think when we look at some of this today, where we're seeing the tax take is it's on the ordinary people, whilst there's some headlines about mansion taxes and things like that, it's actually the tax that's applied to everybody is across most people that are listening today, I think.
yeah. Closely related to that, then, I said about the percentage rate being the other way of taxing people. So the percentage of income tax, and that is increasing in certain circumstances, isn't it?
Yeah.
So 2 percentage points increase at the basic, higher, and additional rates of income tax in regards to property, savings income, and dividends tax. So essentially, if you're an employee, you're not affected. Those rates will stay the same. If you are a sole trader or a partnership receiving trading income, those rates are not affected. So this is quite an unusual situation, I think, where they are raising the rates for income tax in certain areas and not others. So if you've got property income, dividend income, which obviously most people on this call have, or savings income, the basic rate is increased by 2%, the higher rate by 2%, and the additional rate by 2% as well.
Yeah, I think what they were considering in advance of this budget is increasing 2% against every tax band. And I think it's probably a political move at the last minute again about the manifesto saying we're not increasing tax basically on people. Um, and then saying, well, actually, people that run businesses and pay themselves via dividends, which will apply to plenty of people on the call, people that have share portfolios that are outside of ISAs will
Yeah.
increase their tax above the thresholds as well. So it's when we're thinking about all the ways that tax is increasing, it's across broadly a lot of different areas. I think it's fair to say.
And obviously, this is a lot of doom and gloom. But what I would always say is that with owner managed businesses, although you don't get to decide the tax legislation, you do have more flexibility than most in terms of the way that you structure your affairs. So, dividends is a really good example where you can, to a large extent, decide the value of dividends, obviously, up to the amount available of distributable reserves. You can work that out. So, you can play with the amount of dividends and you can also play with the timing as well. So unlike some of the other frustrating measures that came in immediately yesterday, this dividend one doesn't kick in until April 26. So we expect to having conversations with our clients between now and the 5th of April 26 about if there's reserves available in the business, whether you're going to be more tax efficient by declaring dividends earlier. Now, what I would say is tax is only one part of that scenario. It's about affordability of the business. It's about what else you've got going on in your lives. If you're making mortgage applications, funding applications, um, child benefit, etc., etc. There's lots of other knock-on scenarios, and that's why we say, all of this is nuanced because you could just sit here and say, well, why don't we take more dividends before April because it's going to be cheaper. Whilst that is true, there are other implications of doing that. So reach out and speak to us.
Yeah, I think this is going to be a key point with a lot of this legislation. It's not all of it's coming into force immediately. Most of it actually isn't. Some is across the next tax year, but some of these things are coming into force in 2029. So what we don't want to be is too reactive. We want to adapt to legislation with our planning to be sensible, but also you just need to be aware often with things that are announced, they don't necessarily happen and they change and they evolve. So between 2029 tax year, there's going to be several more budgets that will happen. So we want to keep an eye on these changes that are coming down the line, adapt to them, but also not necessarily over adapt and plan too much, I think.
Yeah. So switching lanes slightly, talked a lot about tax there, but there's some changes to ISAs, which is definitely your bag. Do you want to talk about what those changes are and what they mean?
Yeah, so there's been quite a lot of talk. We often get leaks about what the government's thinking about. So there was talks about a British ISA. Again, something that they planned didn't come to fruition because they have this idea and then they look at it, they consult people, actually realize it's quite a bad idea. So one of the ideas that they have is capping cash ISAs. I'm actually not against it in principle in terms of what they're trying to do, because they're trying to encourage people, instead of putting money and holding money in cash, is to put it into stocks and shares ISA instead, or a combination of
Mhm.
both. So what happens for most people, if that's then invested, is they're much better off over time investing it than if it's held in cash. That's obviously over the longer term. I'm a big advocate of having cash as short-term flexibility, peace of mind. But actually, when you look at the rates of tax and the allowances, cash ISAs aren't very effective. So I don't I don't think it's a big loss, the decrease in cash ISA allowance going forwards. Um, and I'm quite pleased that they're keeping the 20k allowance for the stock shares ISA, because of all these increases in taxes in terms of interest and dividends. This is an effective
Mm.
way to hold investments tax efficiently and your savings tax
Yeah,
efficiently.
definitely.
The other bigger
Yeah.
piece that's in there as well is in terms of the lifetime ISAs. So the lifetime ISA impacts largely people buying their first property, but also it's used as a retirement vehicle as well. So there's no immediate change that's been announced in this budget, but what I'm anticipating is going to happen is that there will be changes after the consultation will happen. So it's a little bit light on the detail, but I think what will ultimately happen, is my best guess right now, is they'll reform it to still be attractive to first-time buyers, but then they might tweak it as a retirement vehicle as well, because it's not really what it was originally designed for. Um, so it'll be interesting to see what happens with existing lifetime ISAs. My kind of on my wish list is they get converted to normal ISAs, but we'll see. We've seen this over years and years and years, decades of government policies that products like this are introduced and then they are removed. Um, Short term, they are opportunity planning, but we're also aware of any legislation that these things change, as we're seeing today in terms of the cash ISA as well.
Okay. We'll move on to pensions. I think that was largely unchanged, so there was no change to tax-free lump sums or the annual amount that you're allowed to pay into a pension tax-free. So that has all stayed the same. There was a slightly unusual measure, I think, in regards to salary sacrifice. So I can just quickly take that one. All of you listening to this today, if you're in a company, will be familiar with auto enrollment by now. So you have an auto enrollment pension scheme. There are different ways to contribute the make the pension contributions through the schemes. One of them is salary sacrifice, which has pros and cons. One of the pros was not only do you save income tax for the employee on contributions, you actually saved employers and employees national insurance if you sacrifice your salary. Now, that came with a warning, because you're then reporting a lower salary if you're doing a mortgage application or anything like that. So you've got lower level of earnings. But if that wasn't an issue for you, you would be better off doing salary sacrifice from a national insurance perspective. They've now capped that at £2,000. So you can only relieve £2,000 worth of salary via salary sacrifice and get those national insurance benefits. Anything above that is basically going to be treated as a normal deduction from pay, and therefore subject to national insurance. So that was a change which will affect both employers and employees. Um, and obviously, we need to work out on how to administer all of that and deal with all of that for those of you that are currently on salary sacrifice schemes. And we've not worked that out in the last 20 hours. So we'll need some time on that.
I think a key point on this is it's being introduced in 2029 for a reason. So a lot of the government policy, what they're doing to meet their goals and saying we're being fiscally responsible, is that they're kicking the can down the road with some of the changes as well. So I think one of the primary reasons when they're looking at 2029 as a tax year is because it's messy, it's complicated. They don't know how they're going to administrate it.
Yeah.
So it's one to watch, I think, personally, to see how that evolves with time, um, because the complexity of it. So it's lose lose for employees and employers at the moment. Um, it's saying
Okay.
it's aimed at the rich again, but the reality of 33% of pension schemes are using something like this, so it's going to affect a lot of people. So we'll see.
Okay, and then just some impacts on the state pension, if you want to talk us through that.
Yeah, this is the big one I think for people that are not working. So it's quite a lot of the conversation is quite heavy on terms of people that are currently working, running businesses. The good news out the budget for people that are receipt of state pension is that they are increasing by 4.8% and they're sticking to their pledge to keep the triple lock. Um, this is significantly economically for the country. Then they anticipate it's going to be costing £15 billion a year by 2030. Um, right now, the state pension is costing £138 billion a year. When we're talking about the welfare state, this compromises the majority of our budget, basically. Um, so I think this is a policy again to keep an eye on. They are sticking to it. The last government did. This government are, but they have alluded to that they're going to review this. I think personally, as a personal take, I think it's a matter of time before they change it um, to something that's more sustainable. It's a big vote winner for sure, but it's one of the reasons why we have to keep increasing taxes. So I'm not
Yeah,
saying it's a good or a bad thing, but when we're under pressure, it's a very significant policy, I think, at the moment.
yeah. And then what's the plan?
The other one, which I think is more of a side note in terms of the state pension, actually, is they're reviewing voluntary contributions. This one, actually, interestingly, felt like it was targeted to me living abroad, that I can no longer contribute to my state pension in the UK if I want to. But also in the detail is that they're reviewing this as a whole. So for a lot of people, when they stop work, it might be before state pension age, and
Yeah,
it's in their interest to top up. Might be a few £100 in terms of a contribution, but it can make a significant difference to your pension. We'll see what happens with that, but I suspect there may be some changes in terms of being able to do that going forward. So that's something we'll keep an eye on our clients in terms of reviewing a state pension. Those people that are close, we'll be reviewing to see if we want to make an opportunity there to use the remaining years before there is any changes.
okay, thank you, Adam. Housing and property, a lot of you will have seen this mansion tax. So properties worth over £2 million will now face a surcharge of between 2,500 and £7,500. Don't think that'll be relevant to a lot of people, but just so you're aware. Higher rates on rental income. I think we've already talked about that, which is the 2 percentage points increase at the basic, higher and additional rate for landlords. LISA we've talked about. Um, More relevant, I think, particularly with the clients that we've been looking after, is employee ownership has become more and more common. There was quite a shock announcement on EOTs yesterday, which is from immediate notice as well, so immediate impacts as of yesterday. So this came in yesterday. One of the main attractions to employee ownership was capital gains tax exemption on disposal proceeds received by effectively a business owner, sale of their business to an employee ownership trust. That relief has now been halved. So I think it follows similar precedents to what happened with agricultural property relief and business property relief that there's been a lot of controversy about. Previously, they were, you could pass a business down through the generations and it would be exempt from capital gains tax, from inheritance tax. You could also pass a business to employees through a trust, capital gains tax exempt. All of those things have now been cut in half. HMRC have basically looked at it and said that delays or permanently avoids them ever getting capital gains tax from entrepreneurs selling their businesses. So they're trying to make sure that they get some tax on that as well.
What do you
So
think will happen with that, Paul, in terms of, do you think it will have a material impact in terms of how people are exiting their business?
I think it will make people think twice because obviously there's a lot of media attention around it being capital gains tax free. And the reality is, if you sell to employees, you don't receive a premium for your business. So the carrot was, but it's tax free, and now it no longer is. So effectively, you paid 0% before. Capital gains tax rate for high rate taxpayers is now 24%. So the effective rate is 12% because you're going to pay 24% on half your gain. Half of 24 is obviously 12. So it's still more than what business asset disposal relief was previously, or at 10%. That's going up as well next year. So it gives lots of food for thought, I think, and it's about exploring all the options and different ways of exiting your business. But that is definitely a spanner in the works for those looking at an EOT.
Yeah, it's not an easy budget, I think, for business owners, is it?
Yep. A freeze on corporation tax, national insurance. So none of those rates have been changed. Corporation tax was only recently changed in the UK, but as she continues to bang on about, still one of the most tax efficient in Europe. So no changes on that, Adam. Corporation tax, national insurance
Yeah, I
rates.
think it's very similar to what we're talking about income tax bands in terms of that freeze of the allowances. So there is fiscal drag on that. So more
Yeah.
people, as inflation earnings adjusted for inflation, more people are going to be dragged into paying the higher rates of corporation tax. Um, Same in
What?
terms of NI, employee wages are going up, and
Yeah,
so it is increasing ultimately. NI companies will pay proportionally.
we said before, if you remember, that sole traders and partnerships are unaffected by the 2 percentage points increase on the income tax, which is very interesting because in the last few years, the gap between the tax that you pay as a sole trader versus limited company, if you are a one-person band or two-person band partnership, has that gap has become narrower. Um, Several years ago, it was usually far more beneficial from a tax perspective to operate a limited company. That gap came smaller, and I think yesterday's announcement means it will become even more of a delicate comparison between being a sole trader and having a limited company on the basis that dividend tax has just gone up again. Sole trader tax has not, and then corporation tax only increased not so long ago. So that comparison, if you are running a small business, if you are operating a one-person band effectively, between operating as a sole trader. And don't forget, you can operate a payroll scheme as a sole trader as well. So it doesn't mean you can't have employees. So that scenario, particularly if you're starting a business for the first time, of whether you should incorporate a limited company or not, is a very interesting one now. And then the other one from a business perspective, which I just wanted to sort of play down the hype really, was around capital allowances. So there have been changes on what's called first year allowance. Now, the reality is for most of our clients, the annual investment allowance will cover all of the capital expenditure you're going to make because it allows you to write off the first £1 million worth of capital expenditure in any year against your corporation tax profits. So the first year allowance now, that the changes that have come in, a 40% first year allowance is only for the assets that either don't qualify as plant and machinery under the annual investment allowance, or you've spent more than £1 million. So I think it's going to be a bit of a moot point, that one. But if it does affect you, obviously, we'll be letting you know. Um, I think that wraps up the main headlines that we wanted to cover, Adam, unless I've missed anything.
No, I think that's it.
So do you want to just talk through a couple of ideas and things that you think people should be thinking about, practical ideas on the back of yesterday's news?
Yeah, it's not all doom and gloom. It's fair to say. There's some pretty negative headlines out there, and there's a kind of overshot with it is the highest tax percentage in history. So we can't get away from those facts, and people are going to be feeling that pressure for sure, across the wealth spectrum. As I said before, there's a lot of political headlines about targeting the rich. It's not. It's targeting everybody, this budget, and people are going to feel it from whatever stage in life you're at. But there are planning opportunities still. So for all that doom and gloom, headlines, pensions are still great in terms of tax efficient planning. They're talking about salary sacrifice, but it's still a very tax efficient way to save for retirement. ISAs still apply. a very tax efficient way to shelter savings from all these tax increases that we're talking about. There's obviously allowance for 20k per year, but utilizing that every year makes a big difference over time. Um, and the piece on the pension salary sacrifice is still available as it stands. So some of these things are coming in the future. Some of them will not commit.
Yeah,
I'd bet on that now. I don't know which ones yet, but there will be
yeah.
political change.
And more
Uh,
likely the ones that are further out. That was 2029, I think. So
exactly. So the I think the big thing when we think about this is to zoom out in terms of planning. It's the second budget they've had now. The first, the plan was for the first budget to be where all the pain was. Now, second budget where there's a lot of pain, but it's a political cycle as well. So, what we'll tend to see towards the next general election is the easing of some things, some tax breaks, some tax promises. We'll see what they are, but it's a cycle, and these things that are in place now, the highest tax rate in history, it's not going to be the same in years and years to come. It's just where we are right now. So I think when it comes to personal planning, still keep an eye on the long-term plan. It's not going to, what's coming out in the budget is going to throw anybody off their long-term plan. In terms of short-term, it's just about talking about strategies within a tax year. What can you do? What's the sensible things to do in terms of allowances? That's both from a personal and a business perspective. Doing everything you can in terms of mitigating tax to pay a reasonable amount of tax makes a big difference, I think.
yeah, great. And from my perspective, I think as a business owner, like you say, profit extraction is a massive topic and a thing that you have a lot of control over. Assuming your business is making the money to be able to have profits for you to extract. So on that basis, you can do a lot with timing. You can do timing of your dividends. You can do timing of your pension contributions. Arguably, it's become more and more favourable to consider pensions as some or a larger slice of that extraction because dividend tax has just gone up. Nothing's changed on pensions. Pensions are tax deductible for a company. So that's something you should consider seriously. I always say that if you're going to spend the money that you're taking out your company, go for it. As you always say, Adam, Pura Vida, live your best life. If you're going to spend that money, you
Absolutely.
know, you don't want to be obsessing about putting every penny into pensions just because accountants tell you that it'll save you tax. If you're going to spend it, go for it. And actually, if you want us to gross up what you need to get out of the business to get the same net dividend that you're getting now, we can do that exercise. If you're in the position to be able to also contribute to pensions and you're not going to spend all that money, making enough money in the business to pay yourself more, but you want to avoid the tax, then pensions is a fantastic tax effective way. And obviously, you benefit from that compound growth as well. So that's still really important, but also for your team. Your team might be looking at this thinking, I'm not as excited about the next pay rise because of the fiscal drag, the marginal rate of tax that they're now going to get on that pay rise. You can make voluntary contributions as an employer as well. So you might choose to increase the rate that you pay towards your employees, particularly long-standing ones. Once they've been with the business a certain amount of year, you might have a policy where you pay an extra percent into their pensions, which is, if you look at the data, we've run it before, Adam, because of the compound impact. If they're in their 20s or 30s and they're doing that every year until they retire, the impact is absolutely enormous. And they were only going to get taxed more if they do it as salary instead. You can do one-off pension contributions. You can do a permanent increase in terms of the percentage that you're making there as well. So yeah, although there's lots of negativity in the headlines, as a business owner and with the right partners, there's lots of planning that you can still do to make sure that you put yourselves and your employees and your business and your family in the best possible situation.
Yeah, I think a one positive note to kind of end on in terms of the planning is your investment portfolio. So your investment portfolio doesn't care about what happened yesterday. So there's plenty of conversations I'm having at the moment in terms of going into the budget and the impact. There's no doubt there is impact in terms of the tax planning, and how that impacts our income and what's happening with businesses, whether it be working or in retirement. But your portfolio, if diversified properly, will have approximately 5% in the UK stock market. So if something was going to happen in the stock market yesterday, we'd obviously know by now. It didn't. The stock market was actually up in the UK yesterday by about 0.85%. It was never going to make a difference. And that's the importance of having a long-term plan. And the strategy is that you will remain on track regardless of what's happening in short-term political moves. There's turbulence all the time politically. We've seen what's happened with Donald Trump's tariffs, which did have an impact on portfolios because he almost single-handedly had an impact on the global economy by some of his legislation. That wasn't going to happen yesterday within reason. It would be really hard for Rachel Reeves to crash the global economy. So when we're thinking about the medium and the long term in terms of building wealth for ourselves for the future, financial security in retirement, what's happening short term doesn't have nearly as much impact as I think people think it does. So we haven't really touched upon it in this conversation because it doesn't really matter because
Yeah.
it works.
And obviously, a huge part of that planning conversation for our clients is the sale of their business as well, which has become, more complicated as a result of yesterday's news. If you were thinking of a sale to an EOT, but there are other options: MBO, trade exit, private equity, passing down the generations. They're all still options to consider. And tax is only one element of that. It's an important element, but your passion for the business, your comparison in terms of earnings as dividends, etc., we can map all of that out, and explain the different scenarios to you. So just reach out, as I say, feel free to ask questions in here, but I think you're going to get much better conversations if you reach out directly. Okay. Anything else, Adam?
That's it. We're over. So quite proud to be only 2 minutes over. So I'm not going to add anything.
Super. Thanks, everyone.
Cheers, everybody.